Okay, I'm just trying to set up a couple of things here and then we can start. All right, evening, guys. All right. Hey, I think everything is good now. I would like to welcome you all to our session for Introduction to Financial Accounting. So I know that there might be a little bit of a confusion in the groups because you guys received two links. One link was for 7 o'clock, one link was for 8 o'clock. So like I said yesterday, there are two modules. There's Introduction to Financial Accounting, which is done by Bcom accounting students. And there's also financial reporting and analysis, which is done by everyone else. So the lesson that you are doing today, it's more or less the same thing because we are introducing what accounting is all about. So it's more or less the same thing. So the lesson that we are doing now at 7 and the lesson that we are going to do at 8 o'clock, they are going to cover more or less the same stuff. But it's just that we wanted to separate the classes in a way so that because as you go into unit 2, unit 3, unit 4, you will notice that you start to have differences in terms of the content that you're supposed to learn. So that is why one class is at 7 and then the other class is at 8. So the class at 7 o'clock will always be reserved for the Bcom accounting students, and then the class at 8 o'clock will be reserved for everyone else who's doing reporting and analysis. I just wanted to clarify that so that in case you end up in a wrong class, then you can know what you need to do to correct that. So that's point number one. Then point number two is that there are two lecturers. There is me, James, who will take the 8 o'clock class, and then there is Donnie, who is going to be taking the 7 o'clock class. So we are basically co-lecturers. So you will notice that I will show up in Donnie's lecturers, and he might show up in my lecturers, just helping each other out, especially, maybe sometimes it's not available, or maybe there's a certain area where he knows that I am better at explaining those areas and etc. So we are basically co-lecturers for these two modules. So we'll show up randomly in each other's classes here and there. But for you guys, it's like getting two people in one. So I'm sure you will be happy. You'll be happy with that. So for now, I'm gonna let Donnie do the introduction, a little bit of theory, and then maybe I will chip in into one or two things that I would like to just really zone in, but I'll let him do the introduction and talk a little bit about accounting, and then maybe I'll chip in a little bit later. And then I'll see you guys at 8 o'clock, but I don't think you guys will be joining because you've already covered it. But the guys that will be joining at 8, I will then see them at 8 o'clock. Donnie, you can go ahead.
Right. Thank you, Sir James. Let me just try to record this. Sir James, may you please record the
Yeah,
stop
it's
the
recording. It's recording.
All right, great. Okay, great stuff. Okay, guys, I am Donnie. And I look forward to doing financial accounting with you guys. And without wasting any more time, Sir James has already done the introductions. Let us just jump into the things. I'm going to take it as if we have never done accounting before, just to really try to give a background of this and to explain it from its very roots so that we don't lose each other. Because, when you have a strong foundation, even if things become shaky along the way, you will always be grounded. Right. Let me just cast my screen with my notes. Right. I trust you can see my screen right here. Okay. So I'm just going to be briefly covering the first unit, which is a background to financial accounting. Like I said, I'm going to start from the very, very basics, right? So before we go further, hopefully, but just for everyone's sake, we need to understand what financial accounting is, right? financial accounting. These are two words. There's financial, there's accounting, right? So accounting, what does accounting mean? Accounting means basically recording, being responsible for something, right? Accounting for something. It's basically a verb, right? And then financial, that's an adjective. It means anything regarding money. I mean, financial accounting. So I guess since we all love money, we should we should definitely pass this module because it's relating to money. And I mean, who doesn't love money, right? So, on a literal perspective, financial accounting is about giving a report on financial events, right? So, this is the definition which I've put together to try and really describe this in the way which will make us understand what we are all heading into. Financial accounting is the recording, I wrote it down here, the recording of business transactions and summarizing them into statements for decision making by the users of those financial statements, right? So I'll repeat it again. The recording of business transactions. So we're talking about business transaction. And then we're going to summarize these into financial statements. So you find out that throughout the progression of this module, we are going to be talking, we'll be basically fulfilling the description of financial accounting in stages, right? So it is the recording of business transactions and summarizing them into financial statements for decision making by the users of those financial statements. So obviously, recording, it involves gathering, capturing, and then also overally analyzing this financial information, right? So having spoken about financial accounting, there's also another concept of accounting because there are two types of accounting. There is financial accounting and management accounting. And as a foundation in the background, I want us to be able to distinguish these two so that we don't find ourselves doing management accounting instead of financial accounting, right? So we said in financial accounting, we are recording business transactions, right? So for example, let's say a manager slaps maybe one of the employees. Ha! Smack. I mean, is the accountant really supposed to record that? Is that a business transaction? I mean, what would what exactly are business transactions, right? Because I mean, the manager slapping the secretary, that's more of an HR issue, not a financial accounting issue, right? So it leads us down to basically what type of accounting we are doing. So just to narrow it down, differentiating these two, financial accounting and management accounting, is that you find out that in financial accounting, we are basically focusing on the past, while in management accounting, we are focusing generally on the future, right? Another difference is also the purpose. So in financial accounting, this is more for general purposes. And then management accounting is more specific, right? And then also the focus of what we're talking about. In financial accounting, it's more about the entire organization. Whilst in management accounting, since we said it's specific, it's segments of the organization. And then the users of financial accounting are external, whilst the users of management accounting are internal, right? So also financial accounting should comply to the GAAP, which is the generally accepted accounting principles, right? And whereas when dealing with management accounting, it's not really applicable, right? Now, also the frequency. How frequent do we record financial statements for financial accounting? That is more on a annual, so it's more on a regular interval, annual or monthly. Whereas in management accounting, it's usually recorded when necessary, only when necessary, right? So as I said previously, when we are talking about the example where the manager slaps the secretary, right? Financial accounting, it's strictly financial information, right? Financial, monetary related. If it's not relating to money, it's none of our business, right? Whereas when we're talking about management accounting, it can be financial and non-financial, right? And then the level of details. This one also is just basically telling us that management accounting is more specific. So it can be very, very detailed because it's specific. Whilst financial accounting is more on the overview. So you can see that, okay, these are a bit of shallow waters right here, right? So in our definition, we did say that these financial statements, right, which we are recording into, are going to be used, right? So they're going to be used by certain users. So to understand our users, we need to know the different types of users, right? So our users are obviously businesses, but they're different business combinations, right? So,
Hi, Donnie.
yes.
Yeah, before you go further there, I just want to put a question across to the students, right? Before you talk about the different business combinations that exist. I just want to know from their perspective, who are the different people in an organization that can make use of financial statements, right? It's just a question to the students directly. Who are the different people in an organization or different groups of people in an organization who make use of financial statements? It's an open question. Anyone can answer. You can unmute yourself.
Good evening.
Hi,
Good
Lola.
evening. It's normally your stakeholders. Um, they at your financial statements to see how strong a business is on an annual basis, and it's been done normally by an accountant. So it's basically to show your assets, liabilities, and equity. So basically to show how strong your business is. So it's normally, I would say, your stakeholders, or let's say
But
shareholders,
what are those
your
stakeholders? The stakeholders is
they
a very
normally your
broad.
financial,
Mhm.
yeah, okay. It's your shareholders, or it's the people that's involved in the equity side.
Okay,
It's
that's good.
people
Anyone else want to
that
add what Lola has
either
said?
has put in some.
Okay. Anyone else want to add to Lola? Anyone else?
We still have people that's probably shy.
No, we need to talk, guys, because when you're dealing with accounting, if you guys don't talk, you easily get to the end of the semester and you will not be understanding some of these things that we'll be doing. But in short, what I wanted you to get a note of is that there are so many people in a company that can make use of financial statements. So, for example, like Lola was saying, the shareholders in an organization, they make use of the financial statements. Why do they need the financial statements? Is they need to know whether the organization is making a profit or a loss, right? The employees of an organization can make use of financial information. Why do they need that? They need to know whether their salary is going to be paid at the end of the month or not, right? The suppliers of an organization can make use of financial information. Why do they need that information? They need to know whether this organization is able to pay for what they are buying from them as suppliers, right? The government can make use of financial information. Why does the government need that information? They need it because they need to charge the company maybe some taxes, right? Then what to call these people? The bankers can make use of financial information. Why? Because they need to know if you are able to pay back the loan that you want to borrow from them. So there are so many different users of financial information within an organization, right? There are so many different users of financial information within an organization, regardless of the combination of how the business was created. Okay. Donnie, I think you can proceed with business combinations.
All right. Thank you for that. And thank you for all those who have participated as well, Lola, to be specific. And I hope we're gonna be interacting with one another. Right. So yes, basically different people in the business need financial statements for different reasons as well. Even creditors and lenders also need financial statements of a business so that they can see whether the business is credit worthy, or they'll be able to repay a loan if they are to hand them out a loan, right? Right. So as we continue to business combinations. So firstly, the business combination that I want to talk about first is the sole trader. Well, sole trader, already you can hear that sole, that sounds like a singular, right? I mean, one person. So basically, a sole trader is a business organization that is owned by a single person. And the owner of this business is deemed to be one and the same legal entity, and therefore the owner would be liable for any debts which are incurred as the result of the business operations. So the owner is liable for any debts which are incurred by the business, right? That's basically a sole trader right there. So a person maybe that borrows money to open a business can be regarded to as a sole trader. Okay, so having spoken about that, our second business combination is a partnership. So a partnership, usually it's a business entity where there is a minimum of two partners in this business, where they share profits, and each of them contributes 50% to the capital, right? And they contribute to the business in a complementary way to help the business grow, right? And then having spoken about that, we also have what we call a close corporation. So a close corporation is basically a business which is characterized by mostly the number of owners being ranging between 1 to 10. However, the key characteristic of this type of business combination is limited liability. So this type of business, the owners and the business are considered to be separate legal entity. So you're probably wondering, okay, what is a limited liability? Don't worry, guys, I got you. Because I remember I'm taking this as we do not know this. We are seeing this for the first time. Limited liability simply means that if a business fails or faces financial trouble, the owners or shareholders are only responsible for the money which they would have invested. Unlike a sole trader, right? Here, the owners are only responsible for the amount which they would have invested, not personally liable. That means that their cars, their houses, they are not at risk if this business is to go in debt, right? And then lastly, a company, right? It's very similar to a closed corporation. However, its owners also which are also called shareholders, they also have limited liability relating to any debts incurred by the company. Oh, and also another small fact that I could add is that since 2011, it is actually no longer possible to register a closed corporation in South Africa. However, now those that registered before 2011 are still allowed to operate and trade. That's for a closed corporation, by the way. Now, in a company, owners do not have to be like natural people. Let's say this individual is the owner. It can also be an organization. So basically, a company can actually own another company, right? And then organization can basically own a company, right? So that's what we're talking about. And also, a company can either be profit or non-profit, right? So now to differentiate between profit and non-profit. So a profit company's primary goal is ensuring financial gain for its shareholders, right? So a profit company is driven by the motive of making profit, right? Whereas a non-profit company's primary goal is not to profit, but non-monetary public goals such as charities. I mean, how many have donated to charity? By charity, I'm not talking about Ed Hope, which is KFC. No, I'm talking about an actual organization, right? So, having spoken about that,
Sorry,
yes,
would that include your NGOs under the non-profit? And then the other question, the 2020,
I beg your pardon.
maybe James can help me. Why did they profit organizations? Would that not also be your NGOs? You know, the NGOs that is in the communities, and then
I'm sorry, but you are breaking. I can't really hear you well.
but the network is probably bad. Don't worry, don't worry.
Right, but what I'm hearing is that you are asking whether an NGO is basically the same as a non-profit company, right?
Yebo.
Okay. So
Yes,
what is the yes?
I think that's correct. An NGO normally it is a non-profit company, although it can be a profit company. It just depends with the objectives that have been set up for that NGO. But most because remember, NGO means non-governmental organization. So most NGOs are organizations that are not for profit because they've got certain objectives that they want in terms of the welfare of people and whatnot that they want to achieve. But they can still pursue those objectives while least turning a profit. So it's possible for an NGO to be a profit company or to be a non-profit company, although most of them are non-profit.
I guess your question has been answered because
Thank you.
typically NGOs are not driven by the motive of making profit, although they can make profit depending on their objective, but most of the time their objective is more about social welfare and maybe the environment or humanitarian issues as well, right? Okay. Having spoken about the types of business organizations, I don't know if there's anyone with a question regarding these four business combinations. If there isn't, we can proceed to the accounting equation. Now we are getting into
Okay.
the real stuff.
All right. Maybe before we go into the deeper accounting stuff, on what you covered, I think it's very important for you guys to understand the issue of the sole trader versus the company. The key difference between a sole trader and a company, like Donnie was explaining, the issue of limited liability. So you will notice that most organizations are set up as companies. And the reason why people set up organizations as companies is because of that concept of limited liability that Donnie was explaining. Because you don't want to end up owing a lot of money to people personally as an individual. Because if you get into business and you take a loan and the business does not succeed, it means that you are on the hook for that loan and you can end up in jail because of that. But if you have set up a company, it allows you as a person to separate yourself from the activities of a company. It sounds like fraud. Like, honestly speaking, it sounds like fraud. Hey, this company did this, is not me, but you're the one who was running the company. But it helps you to do that. It helps you to separate your personal activities. So this is why you see a company can close down, right? And they can say the company is broke. but the director will have big cars, will have a big house, and nothing happens to the director. It's because there was a separation between the company and the owner of the company through setting up that vehicle of called a company which has limited liability. So that's one of the tricks. If you are ever going to get into business, do not have a business as a sole trader. You're gonna get into trouble. Set up a company instead so that at least there is a separation between your personal activities, your personal house, your personal cars, your personal bank account, and that of the company. If the company fails, then it ends with the company. It does not get into your own pocket. I think it's just something that is very, very important on the personal side to just know, in addition to what Doni was explaining. So Doni is going to take us through the accounting equation, just maybe an example of what that is. But before he talks about the accounting equation, if you notice there, it says assets is equals to liabilities plus equity and whatnot. He will explain that further on. But I just wanted to because I know that this is not really in your study guide, but I think it's something that is important that you guys need to understand a little bit more. So I want you to understand what are we saying when we are saying an asset? What are we saying when we are saying a liability? What are we saying when we are saying equity? What are we saying when we are saying income? What are we saying when we are saying an expense? Because if you understand those terms, then when Donnie now explains what the accounting equation is, it is easier for you to actually grasp the concepts because you know the terminology of accounting. So it might not be in your study guide for introduction to financial accounting, but I think it is essential for you to really understand the terminology. So for example, when we are saying something is an asset in a business, so you hear the financial manager or the whoever, the CEO saying, these are the assets of the business. What are they really talking about when they are saying that something is an asset for a business? So an asset for a business is anything, right, that any resource within a company that provides an economic value to the organization that you as the organization can control and therefore can derive a future economic benefit. I'll repeat that. I'm saying an asset is any resource that you have in a business, number one, that you control in a business, number two, and that will provide you a future economic value. So for example, let's say that you are in a business and within your business, you have got a building. Right. So the reason why we say the building is an asset is because number one, it is a resource that is in the building. Number two, you control that specific building, which means you own that specific building. It is yours, that specific building, right? Then number three, there is a future economic value. You can get rentals if you were to lend that building to a tenant at the end of the day. So that's what we are talking about when we are saying an asset, right? So examples of assets that you can see in a business, you can talk about, like I was saying, the building, right? You can talk about a car if your business has got some vehicles, whether they are vehicles that are used by the managers or they are vehicles that are used for delivery, they are still assets of the building. You can have equipment. For example, if you are Coca-Cola, and you're operating your plant, your factory, you can have the equipment that is producing the Coca-Cola and etc. That's plant and equipment. That's part of the assets of a business, right? You can have like intellectual property, intangible assets. So for example, if you go into Silicon Valley, in the US where they do, a lot of technology and whatnot, right? Some companies might not have physical assets, but they can own what is called a patent. A patent is an idea of something. So with that patent that they own, they can actually get money with anyone that uses that patent. So that patent becomes an asset because it's a resource, you own it, and it provides a future economic value to the business. Cash itself is an asset to the business. People that owe you money, debtors, right? They are assets to the business because you own them. They owe you money, so you own them. And in the future, they are going to pay you that money. So that's future economic benefit. So whenever you look at an asset, ask yourself the question, is it a resource? Do you have some sort of ownership over that resource? And does it derive a future economic benefit for you as a what? As an organization? So that's how you can define what an asset is to an organization. Then the second thing there, he says that sorry, just give me a second here. He says that liabilities. What are liabilities? What is a liability? So a liability is actually almost like the opposite of an asset, right? A liability is when you, as the company, or when you, as the business, you owe someone money, right? So for example, me and Donnie, we have a relationship in this business that we are running, right? And if I go to Donnie and Donnie gives me 30,000 Rand that I can use to start the business and all of those things. The business does not belong to Donnie, it belongs to me because I'm running the business. But he has borrowed me 30,000. So that 30,000 that I owe Donnie becomes a liability for my business. So liabilities are settled in the future. So it's money that you owe now, but you are going to settle it in the what? In the future. So which means that in the future, there is going to be a loss of value to the business. If I have a liability of 100,000, I can use the money right now that I've borrowed, but it means that in a year's time, in 2 years' time, I am going to lose 100,000 when I pay back that liability. So a liability can be a bank loan, can be an overdraft facility, can be a bond, can be a mortgage, can be tax liabilities or accrued expenses. So for example, if I use water, like city council, you know how the city council operates. If I use water for the whole month and I have not yet paid my bill for the city council, that becomes a liability to the organization because I've not paid my bill, but I have used the water from the from the city council. So that becomes a liability for me as an organization, right? So that's a liability. Then what is equity? Equity, we are now saying that this is how much I own within a business, right? So if I am operating a business, right, I want to start a business today. Let's say that I want to get into property business, right? I have got 500,000 Rand saved, but the property that I want to start with is costing me 800,000 Rand. I go to the bank, I borrow 300,000 Rand, and then I have my 800,000 Rand. What happens there is that I invested 500,000 Rand in the business. So that then becomes the equity or my contribution to the business. So whatever I have contributed to the business is called equity. And whatever I did not contribute to the business becomes the liability that I owe to whoever assisted me to start a business. So you'll notice that when we go deeper, I'm sure Don will explain this to you maybe next week when he gets deeper into the other materials, right? So you will notice that equity increases whenever we have income in the business, and equity decreases whenever we have expenses in the business, right? So our equity increases whenever we've got income, whenever we sell something. Our equity decreases whenever we pay for something, whenever we have expenses within a particular business. I think that that's something that is very important before maybe Donnie just goes into the example of what the accounting equation is, for you to understand that terminology. It will really, really just help you open up your eyes. Donnie, I think you can finish up.
Right. Thank you, Sir James. That has made my work a lot easier than it was going to be.
Mhm.
And I hope now we understand what we refer to by assets, liabilities, and equity. Moreover, the accounting equation says that assets equal to liabilities plus equity. So our assets are equal to liabilities plus equity, right? So in summary, basically, our assets are what belongs to the business, right? The belongings of the business. And then equity, as Sir James said, this is the net worth of an individual or business entity represented by the difference between what is owned and what is owed, right? So as he said, equity increases when there is income. So profit generated by a business, that's actually a form of equity, right? So liabilities, this is the money owed to the creditors by the business, which is basically the opposite of what? Of assets, right? So now I've got a simple example here before we wrap up and conclude. We're going to go into the deeper stuff starting from next week. However, just for you to get an idea of what this equation is all about, here's a simple example. It says a sole trader. So we're talking about a sole trader kind of a business, right? Invest 300,000, right, of her own money into a business. So this sole trader is investing, right? Before we even look further, sole trader, we said what? They are liable for any cost incurred, right, by the business, right? So this sole trader is investing her own money into a new business, right? So what is this? Isn't this an asset? I mean, it's her money which she's putting to the business, right? So now it belongs to the business, right? So in addition, the bank agrees to lend her another 100,000 is capital for the business. Oh, so now the bank is lending us, which means we owe the bank, right? That sounds like a liability, right? I'm sure Sir James explained this pretty well as well, right? Because we are owing the bank. This is the money that we're owing the bank. So it's a liability, right? In this case, she has acquired 400,000, right? So in total, what belongs to the business is 400,000, right? And that is our assets, because we said what? Assets are the belongings of the business. And then she had 100,000 in liabilities, right? Thus, what we said equity is, equity is basically what is owned minus what is owed, right? So we own 400,000, but we are owing 100,000, and that is our equity. So our equity is going to be 400,000 minus 100,000 to give us 300,000. So 300,000 is our equity. I feel like this is the one that's a bit tricky. The other ones are a bit easy to understand. But if you can understand that equity is what is owned minus what is owed, then you basically gonna find it easy to understand the accounting equation. So how is our accounting equation going to look in this case? We said our accounting equation is our assets must be equal to the sum of our liabilities and our equity, right? So we said our assets is 400,000, right? And our liabilities are 100,000. And then our equity is 300,000. And this, my friends, is how it's going to look. So our assets, which is 400,000, because this is what belongs to us, right? And then our equity is 300,000, right? Which is what we own minus what we owe, right? And then our liabilities basically 100,000, which is what we owe. And you look at this equation, it balances on both ends. So basically you find out that now when it comes to recording in our transactions, we're going to be using this accounting equation to record each and every single thing the way it should be recorded, which is something which we're going to talk about as we are going further with this module. However, I need you to understand that your assets must always be equal to the sum of your equity and liabilities. If your equity and liabilities are more than the asset, then there's something wrong. There's a wrong entry somewhere there, right? So this is one of the most very basic examples I could also have come up with. It's also in your study guide. However, I will share the notes, but this concept is going to mean a lot to us as we progress in this module. And I think that will be it from me today. And I'm just going to leave the floor to questions. If there are no questions, Sir James, you can maybe conclude or add something if you want to add something. But this is it from me today.
Right. Thank you, Donnie. Thank you guys for coming through for our first class. Our next class for Introduction to Financial Accounting will be next week at 7 o'clock. Then, like I said earlier at the beginning, we have 2 classes every Monday at 7 o'clock for Introduction to Financial Accounting, and then at 8 o'clock for Financial Reporting and Analysis. As we go further into the study guides, these modules, the subjects will become very, very different. So that is why we separated the class instead of combining them into one. So I'll take the 8 o'clock one because it's much more complicated and etc. And then Donnie will take this one. But whenever we need each other, we'll be available to just help you guys out. I will pop in here and there to assist where I am needed. But I believe you will be very, very okay as you go through. So this is just basic accounting. You just need to know how to do your debits, how to do your credits, and how to do basic financial statements for a sole trader, for a partnership, and for a company. So it's just the basic stuff. And then the deeper stuff, we are going to do it next year when you guys come through for financial reporting standards, when you come through for cost accounting and whatnot. That's where we are going to do the much, much deeper stuff. For now, we're just going to do the basic level stuff. But it is very important for you to understand these things because, like Donald was saying, your understanding of the accounting equation and how it works will help you understand the deeper concepts that we are going to do further on, because they are all based on your understanding of what is an asset, what is equity, and what is liability, and how these things interact in order for an organization to create profit at the end of the day. So I think for today, that's it. I will see you guys next week. Then for those, I think the other guys will be joining me at 8. But if you've attended this one, you don't really need to join in at 8. Please, you don't really need to, because it's more or less the same thing that we'll be talking about. We're not going to be talking about something different. It's more or less the same thing. All right. Good night, guys.
All right.
Thank you,
Good night,
Mr.
everyone.
James.
Thank you, Donnie.
Thank you.